So, you've decided to move back to the UK. Maybe the French bureaucracy finally won. Maybe you miss your family, your friends, a proper Sunday roast, or the particular comfort of complaining about the weather to people who genuinely understand. Whatever the reason, welcome back, or nearly back. Now, before you start bubble wrapping the crockery and arguing about which removal company to use, there are some important financial decisions that need to happen first. Because moving back to the UK has tax implications in both France and the UK, and some of them have hard deadlines that don't wait for the bubble wrap to run out. Welcome back to the Expat Accountant. I'm Ad, a UK qualified accountant and British expat living in France. Today we're covering what happens to your finances when you decide to move back to the UK. This is more common than people expect. Family, health, grandchildren, or simply a change of heart all bring people home. And it's more complicated than people realise, because both France and the UK have things to say about your departure. Quick disclaimer as always, general information, not personal advice. Right, let's work through it. Let's start with the French side, specifically what you need to do formally to exit the French tax system, because just packing up and leaving is not sufficient. France likes to know you're going almost as much as it liked to know you arrived. The first step is notifying the French tax authority, the DGFIP, of your change of address and residency status. You do this through your online impots.gouv.fr account or by contacting your local tax office. You'll need to provide your new UK address and the date of your departure. Your French tax residency ends on the date you leave France and establish your new home in the UK. From that date, you become a non-resident of France. Simple enough in principle, but the tax obligations don't end cleanly on that date. In the year of your departure, you must file a French tax return, Form 2042, covering your income as a French resident from 1st of January to your departure date. You declare all worldwide income for that period in the normal way. If you have French source income after your departure date, a rental income from a French property you still own, for example, you also file a second return, Form 2042-NR, covering that income from your departure date to the 31st of December. If you have no French source income after your departure date, the 2042-NR is not required. But you should note your departure date and new address clearly on your 2042 return and indicate in the additional information box that you have no further French source income. France likes to know, even when the answer is nothing. These returns need to be filed for the year of departure, and the deadlines follow the normal annual tax calendar. Check impots.gouv.fr each March as always. Admin is admin, France is thorough. Now here's something that catches people with larger investment portfolios completely by surprise. The French exit tax, which sounds alarming, and in certain circumstances it is. Here's how it works. If you have been French tax resident for at least 6 of the last 10 years and you hold securities, shares, bonds, investment funds with either a total value of approximately 1.3 million euros or unrealised gains above approximately 800,000 euros, France deems those unrealised gains to have been realised on the day you leave. You haven't sold anything, you just moved. But France calculates the gain as if you had sold everything on departure day and taxes it accordingly at 31.4%, comprising 12.8% income tax and 18.6% social charges following the January 2026 increase. Now here's something else that often surprises people. Post-Brexit, the UK is treated as a non-EU country for French exit tax purposes. This means there is no automatic deferral for UK-bound departures. The exit tax is due within 90 days of departure unless you arrange for a financial guarantee with the French tax authorities or you formally apply for a deferral and meet the conditions. This is considerably less convenient than it would have been before Brexit, when EU departures benefited from automatic deferral until the assets were actually sold. The saving grace is the waiver provision. If you'll hold the assets at the end of a monitoring period, which is 2 years for smaller portfolios, 5 years for larger ones, the exit tax liability is waived entirely. So if you leave France with large unrealised gains, arrange a deferral or guarantee, hold the assets for the relevant period and never sell them during that window. You pay nothing in the end, which is reassuring, though it does require holding your nerve and your assets simultaneously for several years. The key message is, if you have a significant investment portfolio and you're planning to return to the UK, get advice before you leave. The exit tax is one of those things that's much easier to plan around when you have time to do so. What about French property? If you own a home in France and you're returning to the UK, you have a decision to make. Sell before you leave, keep it, or rent it out. Selling before you leave has potential tax advantages. While you're still French resident, your French main home benefits from full capital gains tax exemption in France as your principal residence. The day you leave France, that exemption goes with you. If you sell after you've left, you're a non-resident selling French property and French CGT applies, currently at 19%. Plus social charges of 17.2% on the gain. That's a significant difference. And for properties with large gains, the timing of the sale relative to your departure is worth planning carefully. Keeping the property as a holiday home is entirely possible. You'll no longer be liable for the IFI, which is the French wealth tax on real estate, once you become non-resident, which for larger property portfolios is actually a meaningful saving. But you'll continue to declare any French rental income in France as a non-resident, and any eventual sale will be subject to non-resident capital gains tax. Renting it out creates an ongoing French tax obligation. Rental income remains taxable in France even as a non-resident. You'll need to continue filing a non-resident tax return for as long as you have French source income. France will not simply wave you off at the border and forget you exist. It never does. Right, the UK side. The moment you return to the UK and establish your home there, you start the clock on UK tax residency again. Under the statutory residence test, which we covered in video 1, you will need to go through the same process in reverse. Most people returning permanently to the UK will become UK tax resident from the date of their return, though the precise date depends on the details of your situation. Once UK tax resident, you'll be paying UK income tax on your worldwide income again, your French pension, your French rental income, interest, dividends, all of it potentially back in the UK tax net. The UK-France double tax treaty will again do its job of preventing full double taxation, but you'll need to re-establish yourself in the UK tax system, potentially restart self-assessment if you've been out of it, and ensure HMRC knows you've returned. One important point on national insurance. If you've been in France for several years and haven't been making voluntary NI contributions, As I mentioned in the pension video, you may have gaps in your NI record. Returning to the UK and working will start building your record again. But if you're close to retirement and have gaps, it's worth checking urgently. I should flag an important change here. Until April 2026, expats could fill national insurance gaps with voluntary Class 2 contributions at just £3.50 per week. An extraordinarily good deal. From April 2026, that option closed. Class 3 contributions are now the only option for expats at £17.75 per week, more than 5 times the previous rate. It's still worth doing in many cases, given the state pension benefit, but the economics are less compelling than they were. If you haven't checked your NI record yet, please do so now. I have mentioned this in every video where it's been relevant, and I intend to keep doing so until everyone has checked. You're welcome. Now, here's the part of this video that is genuinely good news. And it's a significant change introduced in April 2025 that most people haven't heard of. When you return to the UK after a period of non-UK residence, you may qualify for what's called the Foreign Income and Gains Regime, or FIG. This provides a 4-year exemption from UK tax on foreign income and gains for people returning to the UK after at least 10 consecutive years of non-UK residence. So if you've been in France for 10 years or more and you return to the UK, for the first 4 years back you pay no UK tax on foreign income and gains, including income from your French property, your French assurance vie, French investments and so on. This income can even be brought into the UK without UK tax applying. It's an extraordinary planning opportunity and one that most people returning from France are completely unaware of. The 4-year window is also a valuable restructuring opportunity. While UK tax on foreign income is suspended, you can reorganise your financial affairs, rebalance investments, restructure holdings, consider whether your assurance vie should be retained or whether its value should be crystallised in a relatively tax-efficient environment before UK taxation kicks in year 5. To qualify, you must have been non-UK resident for all 10 consecutive tax years before your return. So if you left the UK in 2015 and return in 2026, you qualify. If you left in 2017, you don't, yet. The 10-year rule is strict and worth checking carefully. But for longer-term French residents, this is a meaningful benefit that makes the timing of a return to the UK worth considering strategically. Let's briefly cover what happens to your key financial products when you return to the UK. Your ISA, which as we covered in video 6 has been sitting frozen during your time in France, generating income and gains that France has been taxing, immediately regains its full UK tax-free status the moment you become UK tax resident again. Every penny in it is once again sheltered from UK income tax and capital gains tax. This is one of the strongest arguments for not closing your ISA during your time in France, however tempting it might have been. You cannot rebuild an ISA subscription history once it's gone. If you kept yours open, well done. If you closed it, that's a lesson learned and one I hope this channel helps some of you avoid. You can also start making new ISA contributions again from the tax year of your return. The annual ISA allowance is yours again. Use it. Your Luxembourg Assurance vie, as I mentioned in video 9, is specifically designed for internationally mobile investors and can be converted into an offshore bond on your return to the UK. This preserves the investment continuity and allows the policy to benefit from UK offshore bond tax treatment, a topic that deserves its own video in due course. A French assurance fee is less portable. If you hold a French law policy, you'll need to take advice on the most sensible approach, retaining it as a non-resident, surrendering it, or restructuring. The treatment varies by provider and your specific situation. One final point on inheritance tax. As we covered in video 8, the new UK residence-based IHT system means that returning to the UK and accumulating 10 years of UK residence brings your worldwide assets, including your French property and investments, back within the scope of UK inheritance tax at 40% above the nil rate band. For people with significant assets in both countries, this reintegration into the UK IHT net is worth planning for carefully before you return, not after. The FIG regime's 4-year window is partly valuable for this reason. It gives you time to reorganise your affairs before the full UK tax position crystallises. And before you leave France, remember the assurance fee inheritance planning benefits we discussed in video 9. For policies funded before age 70s, beneficiaries received up to €152,500 free of inheritance tax. On your return to the UK, that treatment changes. If your policy converts to an offshore bond, it falls under UK IHT rules instead. The interaction between French and UK inheritance planning across a return to the UK is one of the most complex areas of cross-border financial planning, and emphatically one for professional advice. So, to summarise, leaving France properly means notifying the DG FIP, filing your departure year tax return, and understanding your ongoing French obligations on any French source income or property you retain. The 2042-NR is only needed if you have French source income after your departure date, but always note your departure clearly on your main return regardless. If you have a significant investment portfolio, the French exit tax may apply, and post-Brexit, the UK is treated as a non-EU country, meaning no automatic deferral and a 90-day payment window unless a guarantee or deferral is arranged. The timing of selling your French main home relative to your departure can make a significant CGT difference. Returning to the UK means re-entering the UK tax system. Restart self-assessment, check your NI record, and note that voluntary Class 2 NI contributions closed in April 2026, with only the more expensive Class 3 now available. The Foreign Income and Gains regime gives qualifying returnees 4 years of exemption from UK tax on foreign income, an extraordinary planning opportunity that most people miss entirely. Your ISA immediately regains its tax-free status, and UK inheritance tax on worldwide assets will gradually reassert itself as your years of UK residence accumulate. Moving back to the UK is financially more complex than most people anticipate, but with the right planning, it is entirely manageable. The worst outcomes happen when people move first and ask questions later. The best outcomes happen when people call someone for professional advice several months before they move, while there's still time to do something useful. Thank you for watching The Expat Accountant. If you've watched this far through the series, you know more about UK-France cross-border tax than most people who've lived here for decades, which is either a reflection on how useful this channel has been or of how much there is to know, possibly both. Subscribe if you haven't already, leave your questions in the comments, and I'll see you next Wednesday when I'll be talking about being self-employed in France.